Jeannie Wolf. I'm the CEO of CFA Society Boston. So excited to be here introducing two of my good friends who will be presenting today. But first, I just want to thank all of you who participated in, this is our fourth series in this CAIA partnership that we've done. The first three we did webinars, and now we're going to get a sort of overview of the markets from our speakers today. Those webinars are all archived and saved, so if you missed one of them, you can go back and watch it from our website. But we're very excited. So I think that the topics are real estate, private equity, private credit, and you're just gonna bring them all together today, hopefully. And I also want to promote a few of our upcoming programs. First, our chair, Sarah Samuels, has launched a new podcast series with the society. It's called Pull Up a Chair with CFA Society Boston. Our second episode is releasing tomorrow. So wherever you listen to your favorite podcast, make sure you pull that up. And if you missed her first podcast with Ted Seides, which was released last month, it is amazing. So I encourage all of you to listen to that as well. I understand John has a podcast as well.
I do. Yeah.
So you can
Sarah will
download.
be a guest soon.
You can download that as well. We also have, then we're gonna take a little break for the holidays. And then after the new year, we have our, I think it's our sixth installment of our CIO roundtable. Very exciting. We have a great panel of asset owners speaking on that, and that is on December 31st. Make sure you check out our calendar, check out your emails, make sure you stay up to date on everything, follow us on all the social media channels, and hope to see you in the new year. I am very excited to introduce our speakers today. It's when they asked me to do this, when I saw they were speaking, I thought, oh my gosh, there's two of my friends and such amazing people. And so I'm so excited. Sarah Samuels, who's CFA and CAIA, is the chair of CFA Society Boston. And when she is not spending her time working to deliver value to society members, she is a partner at NEPC. And prior to that, Sarah held positions at Wellesley College, Mass Prim, and Wellington. So she has a long career, and you can hear a little bit about her career on the Society's podcast where he interviews her. So I'm very excited to welcome Sarah. We also have John Bowman, who I have known since 2010. John and I worked together closely when John was at CFA Institute, and now John is just promoted to president of CAIA Association. So we're very excited about that. Congratulations, John. Prior to CAIA, as I said, he was at CFA Institute, where he oversaw the Americas for CFA Institute and also various other roles. He's joining us today with Sarah, and I think it is going to be a fabulous conversation about where the alt markets are going, what's going on, kind of wrapping up what the series was for the first three webinars. So I will turn it over to our esteemed guests. We do have people on Zoom as well, so we're doing this hybrid. If you have questions for the speakers, feel free to chime in when we open it up. But with that, Sarah and John.
Thank you, Jeannie. Hello, everybody, and hello for those of you that are tuning in on Zoom. Wish you were here with us. Let me just first say before I get to our star here, which is clearly Sarah, I'm just here to facilitate Sarah giving you all of her wisdom is my role. But it is so great not only to be back at home in many ways in Boston. I spent the first 10 years of my career here, but at my home society. So even before I was a staff member at CFA Institute, I was first a member of CFA Boston, and Jeannie is just, let me just tell you for all of you members of CFA Boston that this is not normal what you've got here. Part of my job in overseeing the Americas was the great gift of being able to work with, at the time it was 90, probably more than that now in the Americas. But they're not all created equal, and the leadership and the quality of programming and the vibe and community, this is special. So take advantage of it, and I'm grateful for Jeannie and our longstanding friendship. I'm here with my colleague, Christy Hamilton, so make sure you say hello to her. She is actually my co-host on the aforementioned podcast, Capital Decanted, so tune in to that. And Sarah, it is always such a pleasure to see you. I think last time we were at Ted Seide's event together
That's
in
right.
West Palm Beach,
Yes.
the super secret allocator meeting. So I'm not even sure I was supposed to say where that was, undisclosed location, let's just say, in a tax-free state. But it's always good to see you. Happy holidays, everyone. And as Jeannie said, this is kind of a wrap up, a bit of a capstone summary of what has been just a delightful partnership between CFA and CAIA. We have so much in common. Obviously, we're on the same side of the battlefield, trying to do the same type of good work to reform and improve and poke and prod and challenge the industry towards improving investor outcomes. And CFA has been longstanding friends, and we are complementary in the types of asset classes we're serving. So it makes sense to do more of this. So thank you again, CFA Boston, for having us. So turning to you, Sarah, we're going to spend maybe 40 minutes talking through the markets. We'll start kind of a sense of where we are now with some asset classes, and then zoom out slowly through the course of the discussion. I'm not sure how much of the conversation we'll get through, and then we'll leave some time for Q&A, and we'll have you out of here at lunch shortly after. So that will be our plan. That's our blueprint for the next 50 minutes or so. So Sarah, for those of you, the few left in Boston that don't know who you are, maybe we could start a little bit with your past. You've had some asset owner roles. You've spent your entire professional career right here in the city. So walk us through kind of the trajectory and kind of how it has shaped you as a professional now at NAPC.
Absolutely. Thank you, John, and hi, everybody. It's a pleasure to see you all today. I would love to tell you about my background a little bit. First, I'm curious, how many of you are working in the private markets versus public markets? There's been such a blurring of lines, which is why it makes so much sense to collaborate. So who's working in private markets? Okay. And others, are you, the private markets trends and themes, do you feel like they make their way into what you're doing? And that's why you're here. Okay, yeah, so that's what I feel as well. So for those of you on the phone, we have mostly folks who are working in the public markets who are very interested in what we're talking about today and alternatives because it's very important. So I started my career, I was a German major from a state school. I had no idea this industry existed. And I had a guidance, very limited guidance as to how to navigate this. I fell into the industry. I started as administrative assistant at Wellington Management Company. And I thought that's what I would do for a long time. I thought a great role model in this woman who was picking healthcare stocks, who commanded a room and was incredibly talented and renowned, and admired her from afar. And then someone said, "Oh, did you know that Gene Hines started as an admin as well?" And I said, "Oh my gosh." So that kind of opened up the world to me that I could do it, gave me permission. So was at Wellington for 6 years in a variety of roles. Was an associate PM at a small quant shop in RIA where I learned how to trade and build quant models. Realized that was too short-term focus for me, but I learned a tremendous amount and wanted to be more of the long-term investor. So I went off to Mass Prim, which is the state pension fund here in Boston, which was really well respected. And at the time, this was before public funds were sort of viewed as investors or allocators. They were sort of viewed as maybe more of administrative professionals who were pushing through state mandates. But I saw this really talented people at this pension fund, and I wanted what they had. So a lot of people question that decision today would be a no-brainer because Mass Prim has a tremendous reputation. But there I learned how to lead people. I learned how to invest billions of dollars way before I was ready to, which is a wonderful part about going to a place that is lean, and had a great time there, ending my career there as a deputy CIO across all asset classes. But I knew I wanted to work with an endowment to really hone my skills on venture capital. And so I went to Wellesley College, where I invested the pool there for a couple of years. Very different pool, $2 billion versus today, 100 billion for Mass Prim. Very different profile of the portfolios. A lot of time overseas visiting with venture managers. And then NEPC came to my door, and I was a client of NEPC's for 6 years. And they asked me if I would consider coming over. And since that time, I've been overseeing different investment teams. Now it's the entire investment team across 45 people, managing private markets, hedge funds, and more.
It's funny, if you've been in Boston long enough, you know everybody, because not a lot of people leave professionally, but Gene Hines also, when we were 23-year-old analyst schleps going to these IPO conferences, we used to sit together, you know. She's obviously had an amazing career, but a wonderful woman who's doing great work. So the ever elusive soft landing shift into the markets feels like it's kind of happening, and maybe you disagree with that, but it feels like inflation's rolled over, that interest rates maybe have peaked, that jobs are under control. Some of the normal metrics we historically would have looked at feel like they're okay. And yet when we look at private capital, to your earlier question, commitments are down, deployments have slowed. Certainly there's a little bit of a hesitation, almost a sanguine looking out a few years, maybe positivity, but a little bit of, kind of hesitation to pull the trigger. So how in your discussion, starting at the highest level, kind of how have your discussions with clients, how would you describe their emotional state, their confidence level, and where we are with some of these levers?
Yes, it's a great question. So at NEPC, we work with 7 different client types, ranging from the most, open to taking risk on the family office and endowment foundation and healthcare side, to insurance companies, corporate pension plans, defined contribution, public funds is back over the more risk, open to risk. So we have a lot of different clients. We see a lot of different slices of the marketplace. And I would say there's a lot to unpack here. Certainly last year, there were questions about the denominator effect, and we're all familiar with that. It's very easy to observe and understand. And it was an issue for some. That they had gotten outside of the tolerance bands in private markets because of the denominator effect. But more importantly, I believe, was liquidity metrics, meaning how much liquidity did our clients have in their portfolios to cover uncalled capital commitments. And so there were some really powerful and simple metrics that I believe are much more valuable than simply a denominator effect, because you're never going to nail your target allocation. It's constantly going to be off. But making sure that you don't get over your skis like you did and leading up to the GFC is really important. And so we have a system of measuring, we call it a liquidity guardrail framework, and it looks at things like uncalled committed capital as a percentage of monthly liquidity or as a percentage of total NAV. They're really simple. You can set it up like a traffic light system so that you have sort of metrics that tell you you're in the green, that you're in the yellow, approaching a serious zone where you may not be able to meet your capital commitments, or the red. And it's really important when you think about where clients are. We're all just individuals who are subject to all sorts of behavioral biases. We have fears, we have emotions, we have a part of our brain that thinks it's protecting us from bad things, which works great if you're worried about a pterodactyl flying through the window right now, but it doesn't work so well with investing. So emotionally driven decisions aren't great with investing. And I think we have, lots of institutional clients with really sophisticated investment committees, but it's important to remember that even these sophisticated committees are composed of individuals who have their own fears and their own motivations. So without data as fiduciaries, without this traffic light system, it's really easy to make poor decisions out of a place of fear. And so we have spent a lot of time educating folks as to whether they're in the red or the yellow and need to be careful or free up some liquidity, or whether they're in the green and can commit to what might be some very strong vintage years.
Mm-hmm. Well, speaking of pterodactyls,
Yeah.
since you brought them up, yeah. So
Let's see where you're going with this.
Yeah, that was obviously in our transition for our preparation. Yeah. So I mean, if you're not familiar with something, the thought of it is scary, and so I think of, and no offense to the younger talented individuals in the room, but if you're under, let's say, 40. You might have been confused or tricked into thinking that the last 15 years is normal. Like, this is the normal market environment, free access to cash, zero interest rates, like up and to the right all the time. And those of us that, again, have been seasoned and have seen cycles realize that maybe we're returning to more normal. It's not that this is abnormal, it's that this is more normal. We just haven't seen it in a while. So when you think about actual fear, other than the kind of tool set you described, which is outstanding to help you manage and the data, how would you kind of rate their state of mind? Is there still a lot of confusion and a little bit of maybe paralysis because they're not sure what to do? They don't have a playbook for this environment?
It's really dependent on the client themselves and the composition of their committees. But when it comes to I would say managing, this makes me think a lot about the importance of managing teams and the cultural aspects of what you're describing. Like you said, anyone under 37, maybe 40 hasn't really lived through a full market cycle, but probably none of us have invested with inflation like
Right.
this. So we're all figuring this out. And if you're lucky enough to have somebody who invested in the 70s and 80s and, and could impart their knowledge, that would be great. But for the most part, like this is a generation of investors who don't know what the heck we're dealing with. And it's a very strange feeling. And so I do think there is quite a bit of fear in that, we haven't seen a complete wash through of the system. We haven't seen a complete reset. There's been a lot of sort of not enough, I don't think enough cards or hands have been forced in 2023. And 2024 is really going to be the year of what are the impacts of higher rates and higher inflation on companies' financials and really seem like.
Yeah.
So yeah, it's that, but when it comes to the education and understanding what private markets really do, this is the only instance in the capital markets where you're short a call option and you're paying for the benefit to be short that call option. So the GP can call your capital at any point, and in the next couple of years, 3 or 4 years. And so trying to time vintage years is really, really ill-advised.
Well, actually, that's a good segue to a
Mhm.
question I wanted to ask you about. It's one of the few times I'll ask you to pull out the crystal ball.
Mhm.
And that is, historically, when it feels the most scary, vintage years, looking back 5, 10 years, like, wow, that was the time. Yes, the mechanics of this is, as you may or may not be aware of course, is that these commitments come in and then they're not put into the ground or invested, deployed for the next 12, 24, could be 36 months, right? So we're looking at dollars committed now that probably won't be invested until, the late 20s,
Yeah.
mid to late 20s. How would you kind of advise us on these vintage years? Do you expect these will probably, in hindsight, be good times to invest?
Yes, with an asterisk, it will be a good time to invest. Almost across asset classes. The liquidity premium will likely be higher going forward. But what I will say is that GP selection matters more in the private markets than in any other areas of the world. There is no beta, and allocation, and the spread of the distribution of outcomes in venture capital, growth equity, buyouts, distressed debt is tremendous. So we're talking in venture capital upwards of 60, 70, 80% between the top decile and the bottom decile GPs, depending on the time period you look at. In buyouts, it could be 40%. So you really need to have some discretion and some discipline when selecting GPs. It is not which I would argue in the last several years is just, let's find someplace that can take our money.
Right.
Today, you really need to be careful.
Yeah.
You gotta look for folks who have experience in different cycles, who have experience with restructuring, taking over portfolio companies and running them.
Yeah, there's no easy button on the beta play there. So if you can get to the right GPs, I'm hearing
Yes.
most
we need
likely
the right
would be a good
GPs.
time. Yeah, okay. You mentioned denominator effect. I just wanted to circle back to that quickly before we leave, because that was kind of on the tip of everyone's tongue, maybe 6 months ago. Every conference was talking about that, especially the allocators, kind of the liquidity, squeeze that was occurring because you get all these allocations that were out of whack, and obviously liabilities don't care what the market's doing. You have to pay them, as you know well. So, and secondary is kind of popped out of nowhere, at least to a grand stage, because there were a lot of forced sellers for that reason. Where are we in kind of the denominator effect, liquidity chase? Is that rinsed itself out, or do you expect still to see a little bit more of that?
Well, the public markets have recovered nicely, which helps with the denominator effect. When it comes to needing to find liquidity, we've seen some endowments and other types of pools of capital restructuring their portfolio and leading secondary sales. They're definitely happening. They're not ideal in that they take a ton of time. So I worked through a very big, gnarly secondary sale at one of my prior roles, and they take a lot of time. And they take generally a pretty big hit to your portfolio. So as long as you know you can redeploy capital, or if you need to, it's not a great position to be in to have to do a secondary sale. You really want to do it when you're in a position that you don't need that money. But yes, they're happening everywhere. I don't think the secondary opportunity window is closing anytime soon. It's going to work out over the next couple of years. But yeah, we're seeing secondaries in real estate. because that's where the buyers and sellers are not meeting in the middle whatsoever. Nothing is changing hands. So secondaries are a nice option, but they're newer. It's not
Right.
something we've seen before.
And you're dating ourselves with the use of gnarly.
Gnarly.
Yes. But I'm with you. Right, but my point on secondaries is they felt like they were kind of thrust upon us because people were looking for monetization and early departure for purposes of liquidity. But it sounds like, since then, at least it feels like to me, from my perch, a little bit removed from where you are in the depths of these conversations, that secondaries are now kind of being thought of as perhaps a side door in gaining vintage diversification overnight. Has that matured enough where you guys are actually recommending that as a starting point to your private capital allocation?
Yes, and we have for some time. That's not a new dynamic. It's a great way to build a private markets portfolio. If you're doing it from scratch, you get money in the ground, you mitigate the J curve, you might get access to some GPs that would never open their doors for you in a direct relationship. Maybe someday could graduate it from secondary into your primary portfolio. I would say, I had a point I wanted to make, that it's gonna come to me. Your question was,
The maturity of the secondaries market, diversification of vintage,
yeah,
liquidity state.
yeah,
Well, when it comes,
it'll come to me.
yeah. Let's talk a little bit about private credit, just staying with private capital a little bit. Yeah, there was, I think it was Katie Coach at TCW now, who I thought had the quote of the conference at Milken, because it was like one of the one honest voices in there on private credit. It was a bunch of, backpacking and backpack patting and self-congratulations. And Katie, who's got a private debt business, was basically, look, stuff's gonna break. And we're not talking about it. Like, let's all be honest, guys. You can't run an economy on 12, 13, 14% cost of capital. Like, this is great. LPs are loving us right now and we're selling this, but eventually those debt services will come home to roost. So with that kind of intro, where is NEPC on where private credit is in this cycle, maybe with the understanding that this has never really been tested. It's such a brand new asset class.
Yep. So there's a lot of different flavors of private credit. You've got distressed debt, you've got junior capital, which used to be called mezzanine. You've got, opportunistic credit. So lots of different ways to approach it. But at the end of the day, there is a capital gap. And there's a lot of talk about all the capital is flowing into private credit, and isn't that, bubble territory? The reality is that it's just bank capital that's not being deployed because banks are not, there's been a huge amount of bank retrenchment. They're not making the loans that they used to. So it's all coming to the private space. It's sort of a tale of two halves. One is the dollars that are in the ground already. They are going to see some impairment. They are going to see some pain. There are going to be portfolio companies that can't meet their interest requirements. And there are going to be some that, have to either go under or do some sort of expensive restructuring. And then the dollars being deployed today could be very interesting, provided that the underlying borrowers can continue to meet their cost of capital. So to your point, I mean, we've seen a lot of creative financing, and some of it's good and some of it's not so great. One is NAV, so NAV financing, and the jury is out. We'll see if it ends up being genius or if it ends up being a total canary in the coal mine. But this is where the GPs are borrowing at the fund level with the underlying portfolio companies or the capital commitments as collateral. And they're using the proceeds of those borrowings to do a number of things. They could use it to infuse more equity into the struggling portfolio companies in their portfolio. They could use it to do a dividend recap or something like that. They could use it to turn around and give liquidity to LPs so that they can get a good IRR and maybe increase their chance of getting money back. But at the end of the day, like you said, 13% or more cost of capital is a huge ask. And in a time when historically it's really been, we'll underwrite growth at any cost, right? We'll invest in this portfolio company because they're growing really fast. It's okay if they can't cover their, if they're not generating cash flow because the cost of debt is nothing. Today, we really need to make sure that we're focusing on free cash flow as well as growth. We heard one story of a GP who was seeing some opportunity to do some really creative stuff. This isn't even the private credit side, but an equity GP that's doing a credit-like investment, which is a PIK with a warrant attached. Because these portfolio companies need more capital They can't raise the debt because it's too expensive. They don't want to go to the market to get equity because they don't want to price their equity. It's going to come down. And so the idea is you come in with like a 13% pick and then an upward side, which could get you to a 20% return if you exercise the warrant. So the question is, if the banks are not doing it, is that the yellow flag, maybe red flag, that it shouldn't be getting done? The reality is the Fed was trying to incentivize risk taking back when they went to zero interest rates in 08. They were successful. Entrepreneurs took risks and were financed and propped up that maybe should have failed. GPs were launched and received capital and are running funds that maybe aren't as skilled as they need to be, and maybe they shouldn't have been successful. All sorts of things, public markets have taken risks, people have put their capital, so it's worked. The question is, what happens now? Does there need to be a reckoning as the system works itself out in a reset?
I think what makes it even more challenging, and I'd love your thoughts on this, is that we just don't know what's in the box. I mean, with SVB, for example, as ugly and vicious and violent as that was, you know, they're regulated, it's transparent, we know what's on the books, they made an interest rate differential mistake and it corrected really violently, quickly. We just don't know what these loans are, right? They're private by definition. And so it has surprised me how long through this high interest rate struggle, we just haven't heard about many defaults, and the GPs seem to be kind of biding their time well.
Nobody wants defaults to happen, so they're doing all kinds of stuff to make it work. And like I said, that worked in 23. 24 is going to be the year where this is tested to see what happens. So, you know, coming back to private credit and your questions about our outlook there, it's really important to make sure that, again, the GP selection is strong, because there are a lot of players out there who, if things do go under and they need to take over the keys to these portfolio companies and run them, they don't have the expertise. So you really want to look for those with workout and restructuring experience and attorneys on staff.
Yeah. You made reference to real estate and, you know, infrastructure a year ago, again, when, do you remember at conferences when people were talking about the new 40, like fixed income is dead forever. So we got to fill that kind of box that has cash flows that are somewhat predictable and you know, have some level of diversification benefit against traditional equity. Well, obviously with what private credit has done, I don't hear that as much, to say the least. But I'm wondering what you guys are saying about infrastructure, which has a really interesting risk reward structure and cash flow opportunity for a diversified portfolio, but it's just not talked about very much.
Yeah, so we're talking about a lot. And it is picking up a lot of traction. I would say infrastructure is in the midst of an identity crisis. So a lot of folks think they understand what it is, that it's an airport or it's a public toll road or something like that. That's like massive checks that are yielding huge amounts. And it's actually evolved quite a bit to the point that there are some infrastructure investments you can do that have much more of a venture capital type of profile and risk and texture, anything in between to like a private equity operator type of model. So there's a lot of opportunity in infrastructure, and it does make a lot of sense. Fundraising overall in private markets this year is down 45%. Now that's through September 30th. That's a huge dip, and it's that 2022 is down relative to 21. So everything's down except secondaries, but within real assets, there is interest in infrastructure.
Yeah. And then how about real estate? Again, I know you brought it up in a different context, but when you think about the subsegments, which just as you said a moment ago, there's a lot in that box, right? And I think by the way, the theme often when you're dealing with alternatives or private capital is that we sometimes talk about these asset classes. They're much more diversified strategies or buckets of all kinds of opportunities that don't have much in common. So you have to be really careful when you say beta in real estate or beta in infrastructure. It really doesn't exist. So when you think about real estate and all the subsegments and the industries and kind of especially post-COVID, which has been a big part of kind of where your real estate alpha opportunity lies, where are you guys on that?
Yeah, so first of all, there's really not been any price discovery over the last year or two. Nothing's really changing hands because nobody can decide where to meet. So that's very typical. And that's what happened after the GFC. It took a couple of years after everything else stabilized for those marks to finally flow through, because the valuation models, if you're in the position of picking private market GPs, pro tip, ask them lots of questions about their valuation methodologies, because can really vary from one to the next. But in real estate, you're gonna look at transaction-based comps and other things like that. So if there's no transactions, you're not gonna see any change in the valuations. Nobody wants to meet in the middle right now. That said, we do see opportunities still in industrials and multifamily. We would prefer opportunistic real estate investment strategies that can go all the way up and down the cap structure. So there is quite a bit of interesting stuff happening in real estate debt. Similar to private debt, there's a capital vacuum, right? Like there's no capital available for these guys. And so we're seeing a lot of real estate debt funds being raised, which is super interesting. It's another newer area. There's not like a universe to look at. There's not a lot there, but what I would say about that's interesting is that if those folks on the real estate debt side have to take over the keys, the actual keys and run a building, they're better suited to do that than private debt would be running portfolio companies.
Right. I read something recently that the glut of housing is still a major issue. 4 or 5 million house shortage basically this is US population. So I think clearly these multifamily has a long way to run.
That's right. And then on the flip side, industrial, that really has to do with, the consumer hasn't really slowed down yet because we've got people who, if you had to refinance today, you'd be in trouble. You'd be paying an awful lot in interest. But we've got a lot of people who turned out their debt when it was cheap. So they're fine. They're locked in for the 30 rate mortgages. And then they've got this capital that they accumulated through, COVID and post-COVID and the general strong economy. That's actually throwing off some serious cash in high yield savings accounts now. So industrial is a reflection of where, consumers are spending their money and moving the goods around.
Yeah, I think I just bought a certificate of deposit for the first time in 25 years. So there's actually real interest bearing bank notes. Yeah, it's crazy. Maybe we can shift a little bit from asset classes to kind of bigger picture. We joked a little, we're around the same age. So do you remember Ed Hyman at ISI? Like when we were first entering the business, for those of you that don't know, there was actually geopolitics kind of research, sell side. And then of course we had this long kind of post-Cold War period of peace where geopolitics made no difference. It's largely, there were some skirmishes certainly that were hard, but largely a peaceful world. And that has changed considerably in the last couple of years. So I'm curious from NEPC's conversations with your client base, how are they and you thinking about a geopolitical framework when you think about portfolio allocation and geographic exposure, currency exposure, much bigger deal with significant ramifications than we've seen in a long time?
That's right. Yes, and deglobalization leads to all sorts of different outcomes than the globalization theme for many years leading up to it. So there's a lot of attention paid to China, which I remind people is sub 5% of the global equity universe. So it's actually no bigger than, say, some of the European countries or Japan. So a lot of attention is paid there. We use a starting point of the global equity universe. And then from a bigger picture, thinking like the CIO, thinking from a CIO mindset, what is the market cap of all of the investments across the world? And we use that as a starting point to understand what the universe and the starting point would be. And from there, we use a valuation methodology, which we take with a grain of salt, because valuation is not only always early, but oftentimes it assumes a reversion to the mean, which we may not see. And so for the most part, we're not avoiding committing to any parts of the world or investing in any parts of the world, but it is there. Yeah, there's a lot to be figured out.
Do you have to think, or do you counsel clients, maybe is a better way to put it, to abilities of outcomes of some of these either cold economic or sadly even military confrontations?
Yes. And I would put that in the same category as, how we think through election cycles and things like that.
Yeah.
At the end of the day, there's a lot of uncertainty and it's very much not in our control. So yes, the probability weighting is the way to go. But
Would you say, and maybe this is a hard question to answer, do you think there is, Sarah, geopolitical alpha, or do you think there's just tail risk to be avoided?
So,
and maybe that's the same thing.
It's kind of the same thing. I mean, but I think it's a big ask to be able to determine where you want to be in the world at the right time and be tactical. So global equity managers in general in the public markets have been good at that. And in overall, the alpha there is positive, and they're pretty good at deciding where they want to be in the world, relative to a benchmark. But in the private markets, that's not the name of the game.
Yeah, and you don't have the
Yeah.
ability to be nimble even if you wanted to.
Yeah. You know, we're talking about alternatives. I keep talking about private markets, but hedge funds, this is a great time for them. More volatility, more interest rate risk, more inflation.
Yeah, they're
So
back.
global macro strategies have, well, 22 was a great year.
Yeah.
23's been more mixed bag.
Yeah. So another maybe allocation strategy question I wanted to ask you about was CAIA is doing a lot of work on what many will call total portfolio approach, total fund management, the Canadians call it. But basically, just for those of you that aren't familiar with that, it's moving away from kind of a dogmatic focus on strategic asset allocation that has kind of defined our world since Markowitz for 70 years. And we all grew up in this in the academy and CFA and CAIA. We all teach this, like we're all perpetuating this water that we swim in. But total portfolio approach kind of tries to do away, and there's degrees of this, but tries to do away with the over bucketing at the asset class level and takes more of a holistic approach where everything's competing with everything. And then on the back end, of course, you do some risk budgeting, calibrating for board and governance approach. But have your clients started asking, shifting, migrating at all to some form of TPA?
Not as much in terms of everything competing versus one another, but more so in terms of shifting the lens of how to organize your investments.
Right.
And that is more along the lines of role in the portfolio. So a diversifying allocation would be, it would include some hedge funds, it would include not even investment grade, it would include just like treasuries. Or matching economic regimes. So history shows that over time, if you look at the world in terms of growth and inflationary regimes, stagflation is the very least frequent. Historically, it's about 10% of the time. And the only thing that does well then is commodities and maybe some timber. Deflation has been much more prevalent. And the only thing that really does well there is long treasuries. The rest of the time, it's a growth friendly world. So that, 60% of the time you want to be in anything with growth.
Right.
So we've seen folks try to manage their portfolios according to economic regime.
Yeah, and I think you mentioned distressed a little bit earlier, which could have real opportunity. But even picking apart, what does that mean? And how do you deploy or execute on a worldview that thinks that distress will do well, right? You could have a little bit of in your private equity. Certainly there's a lot of private credit distressed opportunity. There's real estate distress. There's hedge funds that are distressed. And pretty soon you find out that you were way more exposed than maybe you thought. This distressed view has suddenly overtaken the portfolio. So how do you, you've kind of alluded to this already, but how do you extract those views and making sure that they're not duplicating risk, overexposing their vision of the world?
So one of the key tenets, I have a couple of key tenets when running my team and how I've taught them to invest. And one is to think like a CIO. So a CIO mindset means thinking holistically across the liquidity spectrum. What do you have in your portfolio in all areas? Especially with larger teams, it's really easy to be siloed. And with 45 people, it's all too easy. So it's almost a full-time job to facilitate this CIO mindset across everyone. And one way to do that is, especially with credit, that's the place where you're going to see people investing in the same issuers with very different trading strategies and horizons in private credit and hedge funds and maybe even long only. So that's an area where you're definitely going to see potentially some overlap, and you want to be careful about how you're approaching it and very deliberate. And then, there's the reality is that taking advantage of distress means that, you really want dry powder for that to work. Otherwise, you're probably going to be selling something the fund that is down, which is not ideal unless you have a big slug of treasuries, which would be dry powder. And so it's unlikely that most strategy types are going to lean into distress in such a way that it moves the needle for your fund. If it's a distressed fund, they'll call the capital, and that'll be something you need to provide to them. If it's a hedge fund, they'll be planning to be opportunistic like that, but otherwise, for the most part, you're fully funded.
Speaking of distress, the ESG moniker has become a bit distressed. I think over the last couple of years, there's been a lot of reasons that that's become a bad word, a political punching bag. And there's nothing like a war in Eastern Europe for us to realize that, wow, this can't go away anytime sooner. There's actually a humanity crisis. So in your discussions more recently, maybe post-Ukraine, Russia, what have the conversations been like when what they're trying to balance is obviously maybe a very strong view of the future that's morally and sustainability driven about a transition, while at the same time understanding that from a beta perspective, like if they would have missed the last 18 months, it would have been really ugly from a relative performance. How are your clients handling that tension?
Yeah, so clients are gonna have just as many views on ESG and what it means as there are clients. The term ESG is going away a little bit and being, I think, replaced with mission driven or something like that. So what we have seen that's not going away is clients who want their investment portfolio to look a lot more like the mission of their organization and the people they represent. So that might be a community foundation that serves a population that's half Black. They want their investment portfolio to reflect that. Or it could be a hospital system that, you know, works with a community that is not reflected at all in their portfolio. So that's an area where we've seen a lot of effort and a lot of money moving. When it comes to ESG, there's such a geographic tilt as well that it really depends. And we've seen some continue to embrace it. Some of the states who really would, I'm not going to get into that, all that. It's a minefield, but I don't think it's going away, but I think it's going to be rebranded.
Yes. Yeah, no, I've seen a lot of just the label on the package is changing, right? It doesn't mean you're not integrating these things. It doesn't have the lightning rod kind of visceral reaction, right? Which I think was maybe a mistake in hindsight. Yeah. Couple more. Start to get your questions ready though. Just a couple more thematic questions that Sarah and I will finish up, and then please have your Q&A ready. So the other thing I wanted to ask you about, it seemed like pre-COVID, you had this huge momentum of co-investing, direct investing, big asset owners deciding to insource, almost Canadian model like, insource some of the investment team, particularly on the private capital side. Save a lot of money, yes, but more importantly, bring that expertise closer to the capital, to the dollars. And, you know, CalSTRS is maybe most famous for doing this collaborative model, but you've seen JVs where different asset owners would either use permanent capital and buy a GP or buy a stake in a GP. Have you seen that pick back up post-COVID? How do you think that trend will kind of
Co-investing?
Co-investing and direct investing and these JVs that seem to be fast and furious a few years ago.
Yeah. So I don't think co-investing is going anywhere. The question is always, how fast can you move? So with governance structure, you really want to make sure if you're going to do co-invest that you are able to move quickly. It's a very detailed and fast moving process from the GP's perspective. It can eat up a ton of time and it's a huge distraction. So but it can help them do deals that they normally wouldn't be able to put together. But getting the legal through, it's really not a feasible approach to say a GP brings you a deal and then I'm going to re-underwrite the entire thing and pull it apart from the bottom. So having some sort of like a strike zone analysis is one way to make sure that you're moving quickly enough. When it comes to, are you getting the best deals or the biggest deals? That's something that you really need to be careful and ask yourself. And when it comes to JVs, I don't see those stopping, although capital is more scarce than it was.
Yeah, and I guess, you know, unlike your old world, Wellesley, the endowments, with a couple exceptions, maybe you can help me, but University of Washington, St. Louis is famous for doing their co-investing aside their GPs, but the endowment stereotype is typically the outsourced GP, right? So most of what we're talking about with these creative solutions are much bigger pools, I assume, SWFs and big pensions. Are you seeing any of that movement in the endowment space?
No. And the big dollars are in the pension funds and sovereign wealth funds. Endowments have a lot of cachet, but they're not the big dollars. So when it comes to leading change in the market or putting huge amounts of dollars to work, it's public pensions and sovereign wealth.
It's interesting. You don't usually see the pensions leading the innovation, but in this case, maybe that's one of them just because of scale, right? Maybe a bit of a awkward one to end on, but private market valuation, another kind of hot potato. But we've had the SEC come out with this ruling that is requiring, at the headline level, let's just be honest, more transparency, right? More fairness in fees. That all sounds good, you know, kind of who can disagree with mother's apple pie. But then when you go down to the detail, obviously there's pragmatism and reality, and certainly there's some GP trade groups that are actually suing against this. Where, if you've got a view, where is NEPC and you personally, Sarah, on some of these changes? Do you think these are good for the ultimately going to be hindering for the industry overall?
Yes, so we've done a lot of work looking into these SEC requirements of GPs, which won't take effect for the next 18 months or so.
Yeah.
And it will be a lot, the GPs have a lot on their plate now to figure out this quarterly reporting and increase transparency of how they're using fees and things like that. But ultimately, that's going to be a good thing. And so we want to make sure that they're well resourced and that they're not taking their eye off the ball when it comes to getting investments done. So smaller GPs are going to feel this burden
Right.
quite a bit. If they were required to reveal or disclose their underlying information, I do think that could be a game changer in terms of their edge and ability to deliver as much value as they do.
In reading some of the, I mean, this is where I nerd out once in a while, but reading the LP letters and the GP letters, it was, to your earlier phrase, a tale of two halves. Like the LPs, obviously there were elements in there that they disagreed with. Like for instance, like we want to be treated preferentially if we're seeding a new manager, and we should get better fees, right? But we agree with fairness generally as a point. But they were largely in favor, and of course the GPs were not. So I assume this will work itself out. We'll find some balance, but it did feel a little bit about the Starbucks moment of private capital, which caused huge changes in private and public trade-offs. And so I guess it remains to be seen what unintended consequences, as always.
Yes.
Yeah. Well, let's turn to the audience. I could keep going with Sarah because I learned so much, but what questions do you guys have?
We're curious, you're talking about early on about allocations to certain managers, the top GPs. And then how is that the effect? So you'll see now that there's huge allocations to the Blackstones of the world, which is kind of like crowding out all the new managers. And this, the questions are they getting so large that they themselves just become allocators because they can't actually put out the capital in such large chunks that now what they're doing is just effectively seeding the larger, it's just kind of like delegating it one more layer. Is that a concern, or is there, how are the LPs, I guess, viewing it?
Yeah, I'll let John chime in as well, but the folks who are committing to Blackstone are going to be the big players who need to deploy billions of dollars a year for the most part. And the markets will take care of themselves. If there becomes too much capital in Blackstone, if they can't deliver on the results, the market will vote with their feet, not continue to commit. But I think your question was a little more nuanced.
Yeah, well, only thing, I agree. If you're having to write a big check, a lot of these emerging or even mid-sized managers, sadly, you might love them. They're not, it's not realistic for your book, right? I would also say there's a little bit of what I used to call when I grew up professionally in Boston, and there was this, I'll never forget, there was this trust portfolio manager I reported to, and I brought this, again, 22-year-old, brought this stock idea, and he said, John, he had the kind of very Boston, bow tie, kind of, aloof answer. This is going to be hard to talk to Mrs. Johnson about. I'd rather talk to her about Disney going down. So the old Disney effect of what conversation do I want to have? If you're newer to private capital, I think there's a lot of pressure to go with safe plays and these big guys. And it's the much more sophisticated folks that have a longer track record that are willing and have the, I think, internal expertise to do the due diligence on some of these younger managers, or the ones that are less tested, the less known. So I think it's a little bit of all that's playing into the megas just getting bigger. Yes.
So we've mostly been talking about privates, but I'm actually interested in your view on hedge funds. So you made a comment earlier about volatility, and that's going to be good for hedge funds, but hedge funds with some sort of beta, not like kind of zero beta hedge funds like absolute return, have actually not done very well. So I'm interested in your view. Do you think that's 2023 issue? Do you think actually the hedge fund industry that has more equity exposure is kind of like classic equity long short is more in decline? Like what are your thoughts?
Yeah, so I think there's a couple of things here. One is the cost of financing, right? To apply leverage is high. So that's one thing to keep in mind, that this is a bit of a headwind, but everything else is supportive. The other is, there is no less homogeneous area of the world than hedge funds. So you really can't make generalized comments about hedge funds. It has to be based on the individual manager. They are tremendously different, and talk about a huge spread of distribution of outcomes. The categorization is loose at best. So we really want to think when we look at hedge fund allocations, it's not filling a bucket. It's what am I missing in the rest of my portfolio that I can't get in the public markets or the private markets? Because if I can get something in my portfolio in a more liquid and cheaper way, more transparent, I'm going to do that every time rather than looking at the capital in a hedge fund or a private market. So when we think about hedge funds, it's what is the role that this allocation is playing, as well as this individual manager. Is it special? Is it something that can't be purchased elsewhere in the public market? Do they have a true skill or an edge? And then thinking about a couple of pretty specific quantitative metrics to understand if that is something that's going to pay off, taking up that space in the portfolio. So I know that answer is not very satisfying. I can't tell you how hedge funds are going to do because they're all doing incredibly different things from one another.
I have a quick follow-up on that. You know, the old days of the titans of Paul Tudor Jones, Soros, Druckenmiller, like these just amazing stories. They lived in a world where there was just a few of them. And so they had cheap access to capital. They had access to information. And now it's a completely different world. You know, there's just so much competition. And maybe the SEC is going to make them publish their holdings anyway. So, but I guess very frankly, like, can macro still work the way it used to?
Yes, and it did last year. Yeah, it can.
So certain periods of
But
time.
it really depends. The devil's in the details. You have to understand how the leverage is managed and applied. You have to understand how risk is managed. You have to understand how the incentives are constructed, especially with these pot shops. There's it's either be killed, you know,
Right.
whatever the expression is.
I got you. Yeah. Yes.
So I'm gonna date myself a little bit along with my gray
You've
hair.
been
but
doing plenty of that. So if you want-
Having grown up in the industry when you couldn't cross trade between portfolios and there was a really seamless transmission between policy and money supply, the flow of credit was very predictable, very reliable. And touching on your comments around private credit, and it almost seems like, and I don't want to put words in your mouth, almost a byproduct of bank inactivity. If you could think about today's landscape with insurance wrappers and moving holdings between portfolios, fiduciary duty, equity, credit, cooperation, things like that. I'm trying not to bias you. Where does it all shake out? It feels like we're at one extreme now, and the other extreme was pre-crisis, 15 years ago. And the answer is usually somewhere in the middle. What does it look like? Fast forward, losses have to be socialized somewhere. Where does it land? What does it look like in 5 years?
I mean, the thing that I think credit is sort of at the root of everything. Like, money makes the world go round. Every car, every house, every corporate credit drives the price of valuation. So if everything's an asset and liability, there should be an arb opportunity, right? And you know, the asset should yield more than the liability. But right now it's inverted, and that's where this opportunity is coming out. It's probably only going to be in place for the next year and a half, at which point it won't be the time to be the lender, it'll be the time to be the borrower again. But I can't tell you, I don't have a crystal ball where things are going to go, but there will be consequences, right? And reaching too far on the risk spectrum, which is what we're talking about, or doing things that are outside of one's zone of genius, is there'll be consequences.
Yeah, I think I wonder a little bit. I'd be curious your thoughts. You know, 15 years ago, it was OCC and Fed regulating Basel III capital requirements, trying to match liabilities and assets, and there's duration seeping in with, I just wonder if there's regulatory risk as well.
Part of the capital private credit needs also are this need to sort of clean up balance sheets and get rid of that lower quality capital. So the regulation is playing in, but I'm curious if you have any thoughts.
Yeah, no, as I said, I think we're maybe starting to see the front end of some of the regulatory implications, and they'll, just like with, not to kind of showcase my opinion too much, just like with Basel and Dodd-Frank, they'll overreach and then it'll be rolled back a little bit, but I do think you're right. The siphon will be plugged too tightly at first, and we'll have to unravel this as we understand what this next chapter looks like. Yes.
Coming back to private equity for a minute, similar question about the risk side. We think about GPs with lines of credit to do financial engineering to juice returns, capital call lines of credit. We think about Fund 4, follow-on investment in the same companies that Fund 3 did, or you have, growth fund selling to lower middle market buyout funds, selling to large buyout fund, right? Just going up the chain. What metrics are you looking at to try to get a sense as to when the music might stop?
Yeah. It depends on the area you're looking at. So we want to look at interest coverage ratios for sure, is one metric. When it comes to sort of valuations were a big one. And what we're gonna see is in 24, 25, and 26, a lot of valuations having to come and set. So you're talking about buyouts. I'm thinking more in venture and growth equity. They're gonna need to raise capital. Yeah. And they haven't. And last round financing is the valuation methodology mostly employed, which is holding things at pretty high levels. So we're gonna see some pretty hard times coming up there. When it comes to buyouts and value creation and, music stopping, it's some really interesting stuff. So number one, we have a whole investment framework to evaluate these things. There's no one or two things that we look at. We have 250 or 300 questions that we answer to get to our decision as to whether an area is something we want to invest in. The buyouts, we really only ever have wanted to pay 2 and 20 or whatever the full rack rate is for companies that generate value through earnings growth or multiple expansion, not necessarily through use of leverage. Leverage is not a skill. It's not something we need to lock up our capital for 12 or 14 years. Theoretically, we could apply it ourselves. So that is something that we have always tried to avoid, is those who are just using financial engineering. When it comes to lines of credit and juicing IRRs, we've always looked at the IRR and the multiple on invested capital, two sides of the same coin, and neither one tells the full story. These NAV loans are very akin, very similar to the credit lines that have been used over the last several years. And then lastly, I would say we're looking at really digging deep in terms of how deals are possibly going to be profitable. Because you've got the cost of capital going from 500 basis points on a buyout deal to 1,100 or 1,200 or 1,300 basis points. You've got companies that are going to be fundamentally weaker than they were, as we see some cracks in demand and inflation, increasing the cost of their inputs. And you've got less leverage going in. So the gearing isn't there. We were just meeting with the buyout manager last week who was doing deals with zero leverage. So it's no longer leverage buyouts, it's just buyouts. So we need to prove to ourselves that we're going to get paid for our capital for the return that makes sense.
You mentioned like hundreds of metrics that you look at or in your investment framework and other metrics. Are you applying artificial intelligence, or you see opportunities to use AI for improving efficiencies in how you capture and use information?
Not for making these types of investment decisions. So I view AI as having 1,000 interns work for you. They're not going to have the business judgment. They're going to get a lot of things wrong, and you need the eyes and the experience to oversee it. So AI makes a lot of sense for data collection. It makes sense for more administrative tasks where you can afford to make mistakes, but not with something like this. But gathering the information and categorizing it and organizing it so that we can look at it maybe, but for us, we're still a ways out. That said, I think it's going to be a game changer when it's ready. It's not ready yet. If you visit Silicon Valley in San Francisco, they'll tell you it's time. You have to get on it or you're going to go under. But it really, this first generation isn't going to be the one. The companies need to start getting ready.
Flags will come up. Maybe to combine a couple questions too on the kind of the size question, and then the kind of the earlier answer from Sarah on your question of kind of where we are. One of the things I'm hearing a lot about is this kind of desire for specialist GPs. Now, there's a trade-off here because typically they also happen to be those with less of a track record. Doesn't mean they're inexperienced. They probably all came from very, high pedigreed environments and backgrounds. But the reality is they don't have the long track record. But because we're in a world now where you can't just lever up, gear up, and through financial engineering, you actually have to be a good operator. You need to understand these businesses and products really well. It's a very different game than the 90s and 2000s private capital world. These specialists, life sciences dedicated GP or an AI dedicated GP, those are, I think, on average, much more interesting to LPs these days. It's finding ways that you can write a check that's big enough and meaningful enough to this smaller manager and getting through policies, especially at a public pension that are politically driven, where you can write, a big enough check to a quote emerging manager. And so I think this is playing out, and some of those mega players that are more generalists, unless they've got teams that are really versed in said industries and subjects, are going to have a harder time telling their story in today's private equity.
I think we have to wrap up.
Okay. Last one. Yes.
Excuse me. I'm from the insurance investment side, so I have a quick question. Earlier you mentioned about the endowments, you mentioned about the pension fund, you're driving the direction about the big money. So how do you feel about the insurance investment, about probably alternative or consulting services? It seems like as an insurance investor perspective, it's more like a let it go in those areas.
Not necessarily. So a lot of insurance companies will have investing off of their balance sheet with surplus capital that's investing in some pretty risky and interesting stuff in the alternatives.
Well, I think we got the hook. So it's been wonderful to spend some time with you. I hope everyone has a great holiday season, and thanks for joining us online. And we'll be around if you'd like to chat some more. So thanks for coming.